Hello, this is Ahura. We'll be with you to review the US inflation data, and then we can check the market reactions as well. As always, let's first check the data. Core CPI on the monthly scale increased by 0.3%, in line with expectations, and slightly above the 0.2% in June. July core CPI annual inflation or core inflation in July increased by 3.1%, slightly more than 3% expectations, while it's increased from 2.9% inflation, core inflation in June. Core CPI index actually also in the bigger picture, or the slower inflation index increased by the to 328.66, slightly above 327.60, which means that the underground inflation is still stickier. CPI headline inflation increased by 2.7% annually, same level as 2.7% that we saw in June. But on the monthly scale, it's increased slightly less than previous month, and in line with market expectations, and 0.2%. So 0.2% CPI, 0.3% core CPI, both in line with expectations. On the annual scale, core CPI increased above expectations by 3.1%. Headline inflation less than expectations by 2.7%. Slightly, market was expecting by 2.8% inflation. So generally, the data, what we can understand, but also I have to mention that the non-seasonal adjusted data also shows that the inflation increased by 0.15%, and real earnings increased by 0.4% after previous month's 0.3% decline. Generally, what we can understand from these data, that inflation, slowing down in the headline inflation, but the core inflation is increasing, and the core CPI index and core CPI index and core CPI index, both of them slightly above the previous months. All together, they can say that while the inflation slightly showing some sign of correction, slowing down, but at the same time, it's sticky there, and headline risk is high. So generally, what we can understand from these data, that inflation is still sticky, and we can still count on like to being slightly harder, to have slightly, we can say that in this, better to say that Federal Reserve will have harder jobs, or we have challenging days to control these inflation or the prices. Generally, as the reaction, if we check the reaction, market reaction, generally we were expecting more than around 90% rates cut for September. That didn't change. Now it's also 94%, generally around this area. Why I'm saying that? Like in 2025, generally we are looking after at least 2 rate cuts. If the federal, we have, and now we have only 3 meetings left in 2025. If the Federal Reserve do not cut the rates in September, they're gonna have to cut the rate in October and December, which is going to be a little bit harder for Federal Reserve to do that. That's why what the Fed is expecting to do. We expect to see that at least 1 rate cut in September, and then another rate cut, depending on the condition, either on October or in December, which most probably will be in December. So that's why if the Federal Reserve do not cut the rates in September, they will have only 2 chances. And if needed, more than 50 basis point rate cut, or more than 25 basis point rate cuts in 2 meetings, then they will not have a chance to do that, unless if they cut the rates by 50 basis points, which can increase the shock in the market. So that's why the Federal Reserve is opening the way for either 2 or 1 or 2 more rate cuts for later this year in 2025. That's why we expect to see at least 25 basis point rate cut in September meeting, even though these inflation data would be show something else on other data. Generally, these data doesn't change our expectation of the rate cut in September meeting, while as mentioned, these data still again showing that the inflation is still stickier, and Federal Reserve will have more challenging days, more harder days to control the data, to control the prices. Let's go to the chart and see how the market reacted to these prices. As initial reaction, the US dollar index lost the ground, like the market says that, well, that's what we can say that is like we put the pressure on the stock on the Federal Reserve to cut the rates. But again, if you go deeper and you look the data deeper in real meaning, it says that the inflation is still sticky. I mean, the more indexes showing there that it's not falling down, it's not easing that fast. That's like many market participants were expecting to see. Still, we do not see any. Still, I mean, the effect of the Mr. Trump's rates, I'm sorry, Mr. Trump's tariffs also still there. So there's a possible effect of the tariffs as well. That's why underlying risk inflation risk is still there. So we cannot count too much on this initial reaction. That's why what we expect from the US dollar index after this data to see the side movement with the positive reactions tendency like around 98% more than above 98. I mean we can expect to see the US dollar index to hold the 98 and above area. These areas. So we don't see that this data can change the market reactions. As for the gold, after reaching to 2,400, we saw some correction in the market. But if you look at the bigger picture, the gold is still there as a buy, and the market's participants still buying the gold. They're still using this opportunity. Gold market is still in a bigger picture side movement with slightly higher or bullish tendency. So and same, we can say that the same positive reaction now we can expect for stock markets, as these data says that inflation is still sticky and there, while the earnings season also is almost over, and we don't have too much big companies left there to shock the market or to somehow give the markets like positive or give the market energy to go higher. That's why we can say that the market's uptrend is it's over. We can say it can be over now in this area, and now we can count on a side movement with slightly downside tendencies. Same for the S&P 500, same for the Nasdaq, and same for the Dow Jones. So side movement with dovish with the bearish tendency is what we expect for the stock markets. Same we can say for Bitcoin as well. After printing a new higher high of 122,000, now we can say time to rest, and these data can confirm the side movement with downside tendency, as we can expect same for the stock markets. Yep, that was the data and possible market reactions. If you had any other question, don't forget to write in the comment section. I'll try to get back to you as soon as I can. Have a good time. Bye-bye.